the biggest insurance mistake you could make. If you do this one thing, you could end up losing your insurance and having to pay tax on your cash value. The most oversold, underperforming insurance of all time. All right, Tom. It's a pretty intense intros there, but basically the most popular thing I see out there is indexed universal life right now.
Yep.
And I think it's overhyped and underperforming and going to be a major problem, whether it's 10 years from now or 20 years from now. I know within 30 years it's going to be a major issue.
100%.
And 30 years isn't a long time when we're talking about someone's lifespan. Right. So, what do you see as some of the biggest reservations you have and concerns?
Well, let's give some history to it first. Whole life insurance, participating dividend-paying whole life insurance has stood the test of time for going on 200 years for some of these big carriers. Really, what happened with universal life became popular in the 80s when you could build a life insurance chassis around a money market-like vehicle that was getting 10 to 15%.
Right, and that was fixed universal life because interest rates were really high, and you could just throw millions of dollars into this thing with a tiny death benefit. So it was just a great way to get tax-free returns on your, instead of putting in money into a CD or a bond.
Exactly. So, but the problem with that was these policies were designed based on interest rates in the double digits supporting their growth. So as interest rates began to fall into the 90s and then 2000s, VUL, variable universal life, became popular.
Because the fuel was the market, right?
And remember the
variable universal life.
Remember the market in the 90s? It was the new economy. It could do no wrong.
I got suckered. I bought a VUL in the 90s.
Yeah, I sold some. So, and that was the idea. Is so now we're not getting fixed rates that are that high, but we're going to illustrate the stock market giving you 15% every single year forever and ever. And then, of course, we saw, the big 3-year down market in 2000, 2002. And then what really killed VUL was 2008 when they said, it was the lost decade of investing, and now the whole promise of VUL was not there. So that what that kicked off was this new design, which is still the same policy. It's still universal life. It still has all the same mechanisms, but the investing strategy is basically a call option spread. But boiling it all down, the promise to a client is they say words like zero is your hero, because they have it on a year-to-year basis, you're guaranteed that your crediting rate is no less than zero, so the market can lose 40 and you get zero. Cool, right? That sounds good. And what they'll also say is upside potential with downside protection. That zero is the downside protection, but you have the upside, and you can participate in an index like the S&P 500 up to a certain cap. Right now, that cap is 9 to 10% most of the time. Not so long ago, I want to say 7 or 8 years ago, you could see 14 and 15% caps. So the thing
that has to do with the options budget, right?
It has to do with the options budget. So when you buy one of these, you're not actually invested in the index. You're the insurance company has essentially bought options on the market that captures the returns between 0 and 10%, and that's not free.
You called that's an option spread.
Yeah, call option.
Call is up.
Yep.
The market's going up, and an option spread is basically saying there will be a cap on what you can get. It's the difference between 0 and 10.
Yeah, so not to get too technical, but if people understand options, then they're buying call options for anything above and beyond today's current market value of the S&P 500, uncapped. It can go as high as you want, but that's expensive. It's expensive to buy that option. So to make it affordable for the insurance company, they also sell a call option at a certain number, like 10% up from the market, and that's how they can use their dollars to capture that. So I always say, yes, zero is your hero in one given year, but the cap is the trap, right? When you buy an IUL, there are fees every single month, right? There are insurance charges, there's premium expense charges, there's a lot that goes into a life insurance contract. So zero is not zero. Zero is a negative number. Sometimes it's a few percentage points. Sometimes these are leverage policies where it can be a lot more than that. So a zero actually is a negative year to your account value.
Because of the fees.
Because of the fees. And then you have to catch up. So the problem is you can't catch up because of the cap. You can't then earn 20% the next year. Yes, the market, when it goes down, it has historically always come back up. But because of the caps, it's set up in such a way where your best case scenario, if you do all the gyrations and run it through your Monte Carlo analysis and all the possible things that can happen, generally speaking, the market loses value about once out of every 4 years, historically speaking. And if you go through all that math, you realize that your best case scenario is probably 6 or 7 based on that. And that's just your best case scenario. The insurance company has the right to reduce those 10% caps all the way down to 2% in some cases. They have complete control over
You'll notice it's a really long illustration in policy.
Yeah.
There's a lot of provisions and moving pieces.
And they have all the control. You haven't shifted any of the risk. They have all control over how that works. So it's fun to look at. It's fun to illustrate. It's a great sales pitch. But long term, your best case scenario is probably what you would have gotten in whole life anyway, with none of the risk.
That's the best case scenario. And so here's the thing. Are you better at mitigating risk than an insurance company?
That's the whole point of the insurance company.
So why are we then removing the risk from the insurance company and putting the risk on the individual? Like,
it makes no sense.
Right. So you can put the risk on the insurance company with whole life and get, but I've seen, people like Doug Andrews say that, oh no, I got a year where I got 100% on my spread, because he's talking about borrowing from the policy and getting whatever, or saying that there was a year where the cap was like, I see these astronomical, like crazy proclamations that aren't accurate. And they're not, if they are accurate in a very short window, they're not accurate in a longer window. And yet people are buying this because it illustrates good, because it looks good on paper. But if they look at the non-guaranteed side, combined with the guaranteed cost of insurance, which there's a difference between current and guaranteed cost of insurance, you'll see it always goes to zero, meaning your account goes to zero.
Right.
And that's a problem.
In all but the rosiest scenarios, that account value will eventually go to zero. And like you said to start, it's usually not 10 years down the road. It's 20 or 30. It's at a time when you're at
when
an
you
advanced
might
age.
need the death benefit.
Right. And when you're at an advanced age and it may be too late to do anything about it or step in.
So does it depend on company to company whether if you borrow, does that change your net amount at risk ever?
Typically, no. So typically, no, you're going to borrow against the contract, and that loan is going to come off of the death benefit or come off of the account.
So it's not going to change the net amount at risk. So that, does it negate any guarantees if you've borrowed or if you miss a payment? Because a lot of people are like, oh, I've got a no lapse guarantee, or I've got but if you miss a payment, doesn't it negate those guarantees in universal life?
Oh yeah. Yeah. If you have a secondary guarantee universal life, where as long as you pay a certain amount, they'll guarantee a death benefit, typically loan events will negate that.
So loan event can negate that, missed payment can negate that. So again, you're taking on all this risk. And I'm going, if you're going to invest in the stock market, invest in the stock market. Don't go do this option strategy inside of an insurance policy. People use my book, What Would the Rockefellers Do, and use Index Universal Life.
Yeah.
But the thing is, the entire book saying that the death benefit is a future asset that's going to replenish and be there for the trust. If you put an Index Universal Life in there, you don't know whether it's going to be there. You've negated the entire concept and created risk, which the Rockefellers believe they took their risks in their business, not with their insurance. Exactly. And yet we're trying to train people like, no, you got to stretch the dollar, get more because you've got this potential upside. But the problem is if it's capped at 10, the market doesn't go 9, 9, 9. And they're like, great, I just got 9% instead of 6. No, it goes up and it goes above 10 and it goes down, it goes below 0. And when you look in the middle, you like I talked to this guy at Indianapolis Life. Actually, my business partner Ray Hooper did back in the day, and he was like the inventor of this.
Yep.
And he was like, it's not going to do what they're illustrating it. He's like, there's no way. It's statistically not possible.
It can't. That sequence of returns, risk, and retirement. We've talked about before. It comes into play in these contracts when they go down, or even they get credited at a 0. It's not 0; it's less than that. So because of those fees, it's almost like draining money out of a retirement account, like you taking money out of your retirement account and making those bad years worse. But here's my overall take on it is, and I try to be fair because I think most advisors that are selling this aren't trying to do wrong. They are trying to help their clients. There may be a lack of understanding, but the way I paint the picture is this: I call it the art of life insurance. I've talked about with you before. There's 3 things that life insurance does really well from a diversification standpoint. One is access. You can access this money at any time without penalty, unlike a 401k or a retirement account. And a big one is taxes. You actually have basically an unlimited tax wrapper where you can multiply money by many times over the course of your life and never owe the IRS a dime on it inside of these contracts. It's one of the last great tax advantages available to everybody. But the third one is risk. That's the R, the ART. So the risk. If you buy a VUL, you're effectively investing in the exact same thing you can buy in your own in a mutual fund or an ETF, and you're just putting a better tax wrapper around it. You haven't mitigated any risk whatsoever. And in fact, there's more risk because of the rising mortality charges in there. Same thing with traditional universal life we talked about. Same thing with IUL. None of the risk is mitigated. With dividend-paying participating whole life insurance that's backed by a general investment account, which is largely a giant bond ladder, through the life insurance contract, the company has guaranteed away all risk. In fact, they've guaranteed not only is it,
Contractually, even.
and they've guaranteed that your cash value must go up every year. The only question is how fast do they enhance that with their dividend. But even if they don't pay a dividend, it's still going up every year. So think about that. If you can get bond-like returns over time, and you will because that's what they're invested in, that's what you have historically gotten. If you go back in time, there's data on that. If you can get bond-like returns, but none of the volatility, none of the risk, what you just created is a better risk-adjusted return. Like this is what they pay the multi-million-dollar salaries on Wall Street to the quants to figure out is how do we, for the same level of risk, get outsized return? You won't get that with life insurance. It's invested in a big portfolio of bonds that you could do yourself. Or how do we, for the same level of return, minimize the risk? And if you can improve that ratio,
That's what you can do.
Whole life can be a better, more efficient allocation toward conservative bond-like vehicles. And then go shoot for the stars with your investments outside of life insurance, with tax efficient or other strategies.
So there's a mutual company that issued universal life, and this is in the 80s, and then people bought the universal life policy, and then they would come out the next year and say, we have an enhanced policy.
Yep.
It could do better. So people would jump ship. They would, is it 1035? Is that what it is? 1035 to the other policy.
Yep.
1031 is real estate. Sometimes I mix those up. So 1035, they'd roll it over unless they weren't healthy. Right. Then they stayed with the original policy. And so as time went on, what happened is these original policyholders went from their initial cost of insurance to the guaranteed cost, which was substantially more, and it destroyed all their cash values.
Right.
And so if they wanted to keep the death benefit, they had to pay the premium with no cash value. But if they were healthy, they could have gotten term policy for 20% less than the lowest possible funding mechanism.
Right.
But that low funding mechanism started to increase with the cost of insurance and now was so much more expensive than a term insurance policy and more expensive than a whole life policy.
Right.
All because they thought, well, I get this really high interest rate. Now let's say, because one thing with whole life is if interest rates just skyrocketed like they did in 2022,
right,
and they just went to 14% all of a sudden. Well, guess what? Dividends aren't going to 14%. They're going to be slow. They're going to creep their way up, but they're not going to get to that. Just like when they go down, they might creep down, but they're going to be higher than these low interest rates. They're a little bit, they're lag.
Yep.
Good in low environments. But if interest rates got that high, I could always take my cash value. And, there's times where a CD pays a higher interest rate in 1 year than it does for 5 years because they expect interest rates to decrease.
Right.
And I could be like, okay, I'm going to buy this 14% CD for 1 year, and then I'll just put the money back in my cash value. I still have this liability protection. I still have a death benefit, and I still have all of my guarantees where if I would have tried to get some type of return in a universal life, I have every year my cost of insurance potentially goes up. The thing that negates that is the more cash value I have in relationship to the death benefit, as you know, it's the net amount at risk. That's where they're assessing the cost.
Yeah.
It gets hidden in the illustration because you never show borrowing from the policy. You just show going up and going up and going up and never utilizing the cash and always max funding it. But then you're like, well, what if you have a bad year? What if you don't max fund it, right? What happens then? What happens if more people per 1,000 die with that policy and they start raising the cost of insurance? If I actually invade that cash and use it for any reason, my cost of insurance goes up in a year where my cost of insurance goes up because I'm getting older. So it goes up because there's more net amount at risk, and it goes up because I'm older. And we stop seeing this hidden factor of we don't notice mortality expense because we never touch the money.
Right.
And here's the deal. What happens if you use that money and it, give the scenarios where it could lapse. The cost of insurance could just rise enough that it could actually eat into this in your later years.
Yeah, the actuaries actually call it the month-iversary. On the month-iversary of the policy, once a month, the charges come out to pay for those mortality charges, and sometimes there's other ones too. And you just described it perfectly. The whole policy, universal life can only work if your money replaces the death benefit at some point, because all they do is charge you based on the number of thousands out there. So if you have a $500,000 policy, it's 500 thousands times the cost per thousand. And that cost per thousand goes up every single year. Whether they raise to guarantee rates or not, it goes up because you're getting older and closer to death. Your actuarial expectation of dying is getting higher. So the problem is that works really nice on an illustration, which is basically just a fancy spreadsheet where they show you compounding at 6 or 7% forever. But that's not how life works. There will be ups, there will be downs along the way. And what happens in the downs, whether you take the money out of the policy yourself, or the market takes it out of the policy, or fees take it out of the policy, if at any point in time your values are lower than was originally illustrated, you know you are paying higher fees than was originally illustrated. And that begins the cannibalistic process of where these policies underperform. And since most advisors aren't doing annual reviews on performance and checking and adjusting, decades can pass. And then when you finally realize there's an issue, it's too late. It's too late.
Yeah. And this is why it's a long-term problem that will be a major issue, because people bought not taking into full consideration where the top end caps out,
Yep.
not taking into consideration if they don't fund it to the maximum amount, how the cost of insurance will be impacted. And if they ever take withdrawals instead of borrowing the money, that impacts the cost of insurance as well. So, and if they miss payments, or, you know, like one of the things that's touted is, oh, universal life is so flexible.
Yeah.
And it's on the insurance test. I remember taking the insurance test, and it was an answer that it was one of the things that touted was flexibility. But the reality is it might be a little bit more flexible in the early years than whole life, depending on how you funded your whole life policy.
Right.
Do you use paid up additions? Is there cash in there? You can automatic premium loans. You know, there's ways that it could be flexible. I see it as more flexible than universal life because the flexibility comes with a really steep cost with universal life. That flexibility comes with consequence, where in whole life, you're going to slow down your cash value, but you're not putting your cost of insurance in a place where it's going to, you know, not be guaranteed anymore.
Right. Well, yeah, I mean, if you sign up for a house and you sign up for a big mortgage payment and the bank gives you the flexibility to pay half or pay a lower amount, but then says if you don't pay double next year, you lose the house, would you do that? It's the same kind of thing.
Well, do you remember option arms?
Mm-hmm.
So option arms had 4 options,
Yep.
right? 15-year, 30-year, interest only, or negative amortization.
Right.
You could pay a minimum payment that didn't cover the interest, and they would add the interest to the balance of the loan.
Yeah.
These were extraordinarily risky because, one, they're variable. So the rate could adjust, and it did, and was part of what really made 2008 such a problem, is because people owed 125% on their home.
Right.
And when the market went down, now they owed 200%.
Yeah.
They just walked away.
It was a
The
better
bank now took on that. So when we look at universal life, it's a lot like that option arm.
Mm-hmm.
Okay, you could pay the minimum, which isn't even enough.
Right.
Or you could pay the maximum, which is the 15-year option. You just it'd be a 7 pay, right?
Right.
Just putting the maximum you can, and that can hide a lot of the problems, but it doesn't necessarily get you to the bridge of where you get to that no lapse guarantee. Not every company has it, but if there's a no lapse guarantee, it says if you get to this age, the policy can never lapse due to those expenses. And so you know you have a death benefit. Why would we add all these moving factors? Why would we move these levers? I have friends. I was a best man at a wedding. Told this guy to work with someone because I didn't sell insurance. He replaced it with an indexed universal life. Then he fired that advisor who sold that indexed universal life. And the analogies this guy was using were like tennis analogies. I don't know what kind of tennis game he's playing, but like, you're taking on risk. If you're going to invest in the market, just invest in the market. Don't do it with your insurance. It's foolish.
Would you open an E-Trade account and set up a call option spread strategy? Name one client that would do that.
Right.
That's what you're getting inside of an IUL. And it makes no sense to me. But the thing is, I don't think many people do understand this, but if you really understand the pricing of that investment strategy, that call option spread, it's based on what they're earning in their general investment account. And it's really this simple, is if they're earning 5%, if they've taken $1,000 and they're earning 5% roughly in their general investment account, they know they've got about $50 of interest they're going to get this year that they can go out and buy those options with. And that's where a lot of that pricing comes from. So if you think about that and you believe in efficient markets, and you should, with all the AI and technology that's being deployed on Wall Street, they're finding every efficiency by the second, then your best case scenario is what you're going to get in a general investment account anyway. So why expose yourself to the risk? It literally makes no sense to me.
Well said.
So I don't understand it. I think it's a great sales pitch. I think it illustrates well. I think the insurance companies love selling it because there's no risk. There's no risk. They would love nothing more than to collect mortality charges from you for 30 years and then let the policy lapse. Like that's a sound business model. It's not aligned with client interests like a mutual company is, because the mutual company has to be there. They've guaranteed everything. They have to operate for the benefit of their policy owners. It just doesn't make any sense. So I don't like to throw anyone under the bus, or I try to be academic.
It's not
about
bad people doing bad things. It's good people with bad information.
That's what it is.
I've seen people on my channel say, I didn't know, I've been selling IUL. I didn't know there was an options budget.
Yeah.
I didn't know that there was calls. Like it's just,
None of that is disclosed. None of that is known by the client or upfront or even by the advisor.
What sucks is it's like, I don't want to be right 30 years from now.
Right.
I want people to make better choices today.
Right.
Like being right 30 years, there's no glory in that. There's no like, cool. It's like, it reminds me of things that I talked to people about when I was on comedy tour in 2020 and 2021. Like, oh, you're going to kill people. No, It was fine.
Yeah.
Nobody got sick at my shows. I didn't get sick, but we were all, everybody was worried with lack of information. And in hindsight, it's like, oh, okay. Now we have, but like, we don't need to wait 30 years to see the problem, because guess what? It already happened.
Yeah.
From policies that started in the 1980s with universal life.
Mm-hmm.
Indexed is just a worse version.
And here's what I come down to it too, is if we know whole life will work, because we know whole life will work, the way it's structured, it has to work. It's just a question of how well it works. Your best case scenario, let's say I'm wrong, and 30 years down the road, IUL or one of these other varieties does better, okay? How much better? What is that incremental better? 10% more cash value, 20% more cash value, whatever, just whatever that is. Cool. But are you willing to risk hundreds of thousands of dollars of your own capital to maybe eke out 10% more, when the odds are showing you that it's probably not actually going to be better? Makes no sense. It's not even like that the odds are in your favor in that bet. It's not like,
what are the chance that you get 10% more?
And it's all about the charge. It's not like the stock market. Like if you invest in the stock market and you're diversified and you have mutual funds, you actually can't lose all your money. Every single underlying company in that fund would have to go belly up on the same day. And there's bigger problems if the entire country.
What everybody's
right.
done at that point. Yeah,
right.
yeah.
But you lose
Terminator 2 level shit.
Exactly. You can't really lose all your money there. But in an insurance contract, you can, because of the rising charges, regardless of what the market does. And that's the thing people miss, is it's not going to be market-like returns. You always have that hit against your account value. I don't see the point. It doesn't make any sense.
Don't see the point. Why do it? If you have one, you can 1035. You move to a whole life policy. You design it properly. Read his book, Permission to Spend. Read my book, What Would the Rockefellers Do? You're going to find out there's a whole world of certainty, and there's an economic value to that certainty. You don't need to speculate. You don't need to risk your money. You don't need to take on all these risks for the insurance companies just because you have an insurance salesman that doesn't know any better. It's time to take back control of your finances. It's time to create the financial peace of mind and confidence that you deserve.